Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Okay, so today we're digging into ARM Holdings plant. We're looking at their latest results, Q2 for their fiscal year 2026, and really their whole strategic direction right now. And honestly, if you follow tech at all, you know the story. It's all about AI compute. The demand is just, it's everywhere. It's huge.
It really is. And that's the absolute core of what ARM is talking about here. This isn't just standard growth. They're positioning themselves as, well, the fundamental tech for this whole AI revolution. I'm talking about spanning everything. Milliwatts on, tiny edge devices, your earbuds, whatever.
Wow.
All the way up to the megawatts needed for these massive hyperscale data centers. It's an incredible range.
And they're making this really bold claim, aren't they? That they're basically the only platform that can deliver AI compute across that entire spectrum, especially with the power efficiency needed. That's a big claim. So the question is, do these Q2 results actually back that up? Is the evidence there across all these different markets?
Well, look, the Q2 snapshot, it definitely shows strong momentum. It's hard to argue with the numbers. Management called it their best second quarter ever. And maybe more importantly for stability, it's the third quarter in a row they've pulled in over $1 billion in revenue. So this isn't just, a one-off licensing deal boosting things. It feels like real scale.
Okay. Yeah, let's get straight into those financials then, because the numbers do seem to suggest something's changing, like an acceleration beyond what maybe even they were expecting.
Exactly. So top-line revenue came in at $1.14 billion.
Okay.
That's up 34% compared to the same quarter last year. Pretty substantial.
34%. Wow.
Yeah.
And how did that compare to their own guidance?
They beat it comfortably. Came in $75 million above the midpoint of their own forecast. So not just scraping by, a solid beat. It says a lot about the demand for their IP right now.
Right. Okay, let's break that down. Royalty revenue, that's the core long-term business. How did that look?
Hit a record. $620 million. That's up 21% year on year.
21%. And I recall they were guiding for something lower, mid-teens maybe?
Exactly. They guided mid-teens, so 21% is significantly stronger. That tells you something accelerated faster than they thought.
So where did that extra kick come from? What drove that outperformance in royalties?
It looks like three main areas, really showing that multi-market strategy is working. The biggest one, the most dramatic, and the one tied right into the AI story is the data center. Royalties from their Neoverse platform, they more than doubled year on year.
Doubled?
Yeah.
In the data center. That's huge.
Yeah, driven mainly by these custom chip deployments by the hyperscalers. They're building their own chips based on ARM Neoverse.
Okay, so data centers exploding. What about the traditional stronghold, smartphones?
That was the second big driver. Now, the overall phone market isn't exactly booming, right? But ARM's royalty growth within smartphones was actually faster than the market overall.
Interesting.
It comes down to the mix. More and more chips shipping are based on their newer, higher-value ARM v9 architecture. And also, crucially, their compute subsystems, the CSS stuff.
Ah, okay. So it's not just shipping more units, it's shipping more valuable IP per unit. They're getting a higher royalty rate.
Exactly. Customers are choosing and paying for the more advanced, more complex IP because they need the performance, especially for AI features on phones.
Got it. And the third piece, driving royalties.
Automotive and IoT. Now, they didn't double like the data center, obviously, but they showed good, solid year-on-year growth, consistent contributors. So when you put it all together, you've got market share gains, particularly in the data center, plus those rising royalty rates, especially in mobile. Both things are happening at once.
Okay, that makes sense for royalties. Let's switch to the other side, licensing. Licensing and other revenue was up even more steeply, right? 56% year on year, $515 million.
Yeah, 56%. It's massive. And it really shows companies are locking in access to that next generation technology now. They're not waiting.
What's behind that huge jump? Is it just a couple of massive deals or something broader?
It's strong demand across the board for that next-gen IP, but also these deeper strategic deals they're signing, multi-year stuff. And yeah, there was a big component from an expanded deal with SoftBank. That's tied into the whole Stargate AI project we'll probably talk about later.
Okay. And specifically, they signed, 4 ATA deals and 3 CSS deals in the quarter?
That's right. 4 architecture technology access deals, that's broad access, and 3 more of those compute subsystem deals. So continued momentum on both fronts.
Now, licensing can be lumpy, right? Big deals land, then maybe it's quiet for a bit. Management always points to annualized contract value, ACV, as the better underlying trend indicator. What did ACV do?
Right, and this is maybe the most telling number for their strategic momentum. ACV grew 28% year on year.
28%, okay.
And critically, that's the same strong 28% growth they had the quarter before. So it's not a blip. It's sustained momentum.
And how does that 28% compare to their usual run rate or their long-term targets?
It blows them away, frankly. Their typical run rate has been more like low teens growth, and their long-term expectation for licensing was always sort of mid to high single digits.
So going from maybe 7, 12% historically to a sustained 28%, what does that signal about what customers are doing?
It signals a really fundamental shift. Customers aren't just renewing old deals. They are actively strategically deepening their commitment to Arm's future roadmaps, and they're doing it at a much faster rate. They're essentially paying upfront for access to architectures they know they'll need for AI, whether it's mobile, auto, or data center. They need that advanced, power-efficient IP ready to go. It's a huge leading indicator for future royalties down the line.
That sustained high ACV growth really does paint a picture of future potential.
Okay, before we move off financials, profitability. With all this growth and the R&D push, did margins take a hit?
You'd think they might, but no. Non-GAAP operating income was up 43% year on year, hit $467 million.
43% growth in operating income.
Yeah, and that actually improved their non-GAAP operating margin. It went up to 41.1% from 38.6% a year ago.
Wow. So they're investing heavily, but also getting more efficient.
Seems like it. Strong operating leverage. And their non-GAAP earnings per share, 39 cents, that also beat their guidance midpoint by about 6 cents. So yeah, managing costs well, even while scaling up R&D.
Okay, let's pivot then. Let's talk specifically about the data center. This seems to be where the AI impact is most sort of structurally transformative right now. You mentioned the conversation around data centers has shifted. It really has, and it's central to Arm's relevance. It used to be all about raw processing speed, maybe chip cost. But today, the absolute biggest bottleneck for building out these massive AI data centers isn't just the chips themselves, it's power. Getting enough power infrastructure in place.
You mean actually getting the electricity delivered?
Exactly. Not just the cost of the energy, but the physical grid capacity, the transformers, the turbines, all the stuff needed to deliver hundreds of megawatts, sometimes gigawatts, to one site. Power availability is now pacing AI deployment globally.
Okay, so if power is the ultimate limiter, then chip efficiency stops being just a nice-to-have feature and becomes the absolute #1 competitive factor.
Bingo. And that's Arm's entire pitch right now. They're positioned as the efficient solution. They cite their architecture as being roughly 50% more power efficient than legacy competitors in a typical data center workload.
50% is a massive claim.
It is. But they say it's backed up by benchmarks and, importantly, by what the hyperscalers themselves are seeing in real-world deployments.
Right.
And look, when every megawatt is gold dust, saving 50% isn't just incremental. It could be the difference between deploying your new AI model now or waiting a year for the power grid to catch up.
Okay, I have to push back a little. A 50% efficiency gain is huge. What technically gives Arm that edge? How can they claim that against entrenched players?
Well, it's partly the instruction set architecture, the ISA. It's generally simpler, needs fewer transistors, less energy per calculation compared to older, more complex ISAs. But maybe even more critical in the data center is customization. These hyperscalers, your AWS, your Google, they're not just buying off-the-shelf chips. They license Arm's Neoverse IP, and then they customize the heck out of it.
Tailoring it specifically for their workloads.
Precisely. They strip out anything they don't need. They optimize the data paths, the cache hierarchies, everything for maximum performance per watt for what they run in their cloud. You just can't get that level of optimization with a rigid general-purpose chip design.
And we're seeing the proof in the pudding, right? The Neoverse platform just passed 1 billion cores deployed.
Yeah, a huge milestone. 1 billion CPUs. And these aren't just anywhere. They are the literal foundation for this whole custom silicon movement. Think about NVIDIA's Grace CPU, AWS Graviton, Google Axion, Microsoft Cobalt, all the big cloud players building their own critical infrastructure chips. They're building them on Arm. That tells you efficiency and customization are table stakes now.
That Google Axion example you mentioned, The numbers there are pretty staggering.
They really were. Google's moving most of its internal stuff, infrastructure, apps onto Axion, and they reported, what was it, up to 65% better price performance?
65% better price performance.
While using 60% less energy. 60%. At Google's scale, that is just colossal. It means they can basically deploy way more compute within the same power budget. It's transformative.
And it's not just about replacing the main CPU, is it? ARM cores are also playing a role alongside those big AI accelerators, the GPUs.
Exactly. They're increasingly used with things like NVIDIA GPUs. The ARM CPU acts as the kind of efficient manager of the whole system. It handles the orchestration, the data movement, security, managing the whole cluster, freeing up those power-hungry AI accelerators to just focus purely on the intense math they're designed for. So ARM becomes essential for managing the complexity while still being super power efficient itself.
Okay, speaking of massive complexity, Stargate, this huge, almost mythical $500 billion project with SoftBank, OpenAI, building next-gen AI factories, ARM seems to be getting more involved, or at least have more visibility now.
Yeah, they mentioned adding 5 new Stargate sites or getting visibility into them this quarter. It just reinforces how central ARM is to that future hyperscale roadmap. And management said something really interesting. They feel the demand for compute, driven by things like Stargate, is actually stronger now than when that whole project was first announced nearly a year ago.
Stronger now. So that $500 billion might even be conservative. The demand curve just keeps getting steeper.
It seems that way. It really explains the frantic pace of investment we're seeing everywhere. And you can see ARM's piece of this growing in their own numbers. If you look at infrastructure royalties, that's cloud and networking combined, it was about 10% of their total royalties at the end of last fiscal year.
Okay, 10% last year. But given that Neoverse doubled year on year, that mix must be shifting fast.
It is. Management suggested it's reasonably heading towards the 15% to 20% range this year. That's a significant and rapid shift towards these high-value data center royalties. It's ARM displacing older architectures in the core of the internet.
And it's not just the main server CPU. You mentioned ARM is also deep in the networking stack.
Oh, yeah, it's everywhere there, too. It's the control plane brain. It's in DPUs, those data processing units like NVIDIA's Bluefield that handle network tasks. It's embedded inside the big switching and routing chips from folks like Tomahawk and Arista, running telemetry, system management, all the crucial low-level stuff needed to manage the high-speed fabric connecting these AI clusters. ARM is becoming the standard there, too.
That data center story is incredibly compelling. Okay, let's shift gears completely. From megawatts down to milliwatts. Let's talk about the edge, mobile, IoT, and specifically this compute subsystem, or CSS, strategy.
Right, CSS. This is probably their most important strategic product push in recent years, maybe outside of Neoverse. Think of CSS as like a pre-built, pre-validated bundle of their best IP. You get the latest CPU cores, the GPU, the interconnects, AI accelerators, all integrated and optimized together as a single block that a customer can license.
Okay, but why would a chip company who's used to licensing individual IP blocks and putting them together themselves want this prepackaged thing? What problem does it solve for them, especially if it comes at a higher royalty?
It solves the biggest headaches in chip design today.
Right.
Complexity and risk. Designing a modern, high-end mobile chip, especially one packed with AI features, is insanely complex. Integrating all those different IP blocks efficiently takes huge teams, huge amounts of time, and there's always a risk something goes wrong and delays your launch.
Right, time to market is everything.
Exactly. CSS takes a lot of that integration risk off the table because ARM has already done the hard work of putting the pieces together, validating them, optimizing how they work as a system. It massively speeds up the design cycle for the customer.
So the customer gets to market faster with less risk, and ARM gets?
ARM gets 2 things. 1, faster time to market for the customer means royalties start flowing sooner. 2, because CSS is a much more complex, higher value, pre-validated system, it commands a significantly higher royalty rate than just licensing individual lower value IP cores. It aligns incentives perfectly.
And the adoption seems to be proving the concept. 19 CSS licenses signed now across 11 companies, and we're seeing it in phones already.
Yeah, the top 4 Android phone makers are shipping phones with CSS-based chips right now. The Samsung example they gave is a good one. Samsung's using CSS in their Exynos chips. And they reported getting up to 40% better AI performance compared to their previous generation chips that didn't use CSS. That's a direct result of that pre-integration and optimization ARM did.
40% better AI performance on the phone. That's noticeable. And they're not standing still. They just launched Lumex CSS. What's new there?
Lumex is the next evolution, announced back in September. It's specifically designed as their top-tier mobile platform focused squarely on enabling really rich on-device AI experiences. Things like real-time translation happening instantly on your phone, sophisticated photo and video enhancement, powerful personal assistants that work even when you're offline. It's about bringing that AI power directly to the edge, minimizing latency and reliance on the cloud.
And when do we expect to see phones using Lumex?
Flagship devices from partners like Oppo and Vivo are expected to start ramping up later this year, so we should see phones hitting the market soon with these new AI capabilities, plus things like console-level gaming performance. It's another step in pushing AI compute out from the data center.
What really struck me was the comment about already getting royalty revenue from Lumex, even though it only launched in September. How is that even possible? Chip design cycles are usually much longer.
That speed is the ultimate proof of the CSS model working, and the benefit of these deep partnerships. The specific licensee they mentioned, whoever it was, had already licensed ARM's first-generation CSS product. So the teams already knew how to work together, the software tools were likely in place, the whole integration path was established.
So transitioning to the second generation, Lumex, was much faster because the groundwork was done.
Exactly. That prior relationship and shared experience compressed the design cycle dramatically. It shows how CSS isn't just about the IP, it's about streamlining the entire development process, which means ARM sees the revenue much, much faster.
That really highlights the friction reduction aspect.
Okay.
Okay, quickly, any other highlights from the broader edge market, automotive?
Yeah, momentum across the board. Google's Pixel 10 came out with their new Tensor G5 chip, ARM-based of course. Google said it runs their Gemini AI models 2.6 times faster and twice as efficiently as the previous gen. Again, crucial for battery life and user experience on device.
And for developers working on AI?
NVIDIA started shipping the DGX Spark. That's basically a compact supercomputer for your desk running on ARM. It lets AI developers do serious model training and inference locally without needing constant cloud access, bringing AI development power closer.
And automotive. Still seeing big leaps there.
Absolutely. Automotive is huge for complex, safety-critical AI. They mentioned a flagship EV using ARM, introducing advanced park assist, voice control, new safety features. But the really eye-popping number was from Tesla. Their next-gen AI chip, the AI5, also ARM-based, apparently delivers up to 40 times faster AI performance for their vehicles.
40 times. That's not incremental, that's a generational shift.
Yeah.
What allows that kind of leap in a car?
It's specialized architectural features designed for that high-throughput, safety-critical AI inference. Things like those scalable matrix extensions we talked about earlier, optimized for the core math behind AI models. Combine that with the car maker's ability to customize the silicon for their specific sensors and driving tasks, and you get these massive performance gains all within the tight power and thermal limits of a vehicle.
Okay, the common theme here, data center, mobile, auto, is the massive investment needed to create this tech. Let's talk about ARM's R&D spending, strategic moves like acquisitions, and that SoftBank relationship.
Yeah, the investment is serious. Non-GAAP operating expenses hit $648 million, up 31% year-on-year. That's a big jump. And they said it's almost entirely driven by R&D investment and hiring more engineers. They're basically hitting the accelerator on developing future tech.
Where's that R&D money going, specifically, beyond just the next Neoverse core iteration?
Seems like three main buckets. One, the next generation architectures looking out 3 to 5 years. Two, continuing to build out and improve the CSS offerings. And three, maybe the most interesting strategically, they're explicitly exploring moving beyond just IP, looking at potentially offering more complex building blocks like chiplets, or maybe even designing and selling complete systems on chip, full SoCs.
That's a big potential shift, and the scale of R&D is huge, right? The Lumex CSS example.
Yeah, that really puts it in perspective. Developing just that one mobile platform, Lumex, cost hundreds of millions of dollars and took about 1,000 person-years of engineering effort. They had over 450 engineers working on it at its peak. That's the kind of resource needed to stay at the cutting edge.
And they're not just building organically, they announced an acquisition too, DreamBig Semiconductor.
That's right. An intention to acquire DreamBig looks like a very targeted strategic buy.
Why DreamBig? What do they do?
They specialize in IP for high-speed data communication, specifically Ethernet controllers and, more importantly, RDMA controllers.
Okay, refresh my memory. RDMA. Why is that important for AI?
RDMA stands for Remote Direct Memory Access. Basically, it lets data move directly between the memory of different servers or between servers and AI accelerators without bothering the main CPU. In these giant AI training clusters, you're moving insane amounts of data between thousands of nodes. RDMA is critical for doing that super fast with very low latency. So acquiring this tech strengthens ARM's hand in that crucial high-speed networking piece needed to connect massive AI systems.
Got it. Okay, now, the sensitive topic. Related party revenue. SoftBank is ARM's biggest shareholder. That revenue stream jumped up quite a bit this quarter, tied to Stargate.
It did. It was noticeable. Q2 related party revenue hit $178 million. That was up about $52 million from $126 million the quarter before. Management called this new level a good run rate going forward.
Right, but the question is this real durable business or just SoftBank shuffling money around? What is ARM actually doing for that $178 million?
It's a fair question. They described it as a mix of IP license deals and design services. The design services part is key. It's essentially a funded R&D model. SoftBank and its Stargate partners need cutting-edge, highly customized chips and systems designed for this massive AI infrastructure. They're paying ARM's engineers using ARM's IP to help design those systems.
So ARM gets paid to basically develop its most advanced future technologies, tailored for the biggest AI projects.
Pretty much. It lets ARM push the boundaries on complex SoC design for AI without having to foot the entire bill themselves. They gain invaluable experience working on these bleeding-edge, large-scale systems.
But you also mentioned this design service revenue is lower margin.
It is lower margin than their core IP licensing or royalty revenue, yes. But they argue it's durable because it's tied into this massive long-term Stargate effort with multiple partners. It's not just a one-off project, and it positions ARM perfectly for that potential next step.
Which is the potential move into selling physical chips. If they're designing these complex SoCs for Stargate partners, maybe they eventually sell them directly.
That's the billion-dollar question, isn't it? It would be a fundamental shift from being purely an IP company. Management was very careful here. They laid out 3 specific milestones that must be met before they would even announce selling physical products.
What are the milestones?
First, the chip design has to be finalized and sent for manufacturing. That's called tape-out. Second, they have to get the physical silicon samples back, test them, and prove they work. And third, they need firm, non-cancelable orders from customers. Only then would they talk about it publicly.
So nothing official until all those ducks are in a row. But let's speculate, why would ARM even consider this? It risks competing directly with some of its biggest licensees like Qualcomm or MediaTek or even the hyperscalers. Wouldn't that alienate them?
It's definitely a risk. But the thinking might be focused on the very highest end, the most demanding, perhaps lower volume infrastructure needs. For something like Stargate, where every watt and every ounce of performance is critical, maybe only a chip designed end-to-end by ARM itself can meet the specs. They might not aim to compete broadly, but rather target these ultra-specialized, highest-margin systems where deep integration is paramount, maybe systems their traditional licensees aren't building.
And if they did start selling chips, how would that impact their financials? Would it replace the licensing and design service revenue?
It would likely be somewhat cannibalistic, yes. That funded R&D revenue might decrease if they're selling the end product instead. But the flip side is they'd capture the full value of the chip sale, potentially plus ongoing royalties, plus future generations of those chips. It would make their revenue model much more complex, a mix of IP, services, product sales, royalties. It signals how massive they think this AI opportunity is, that they'd even contemplate changing their fundamental business model.
Truly fascinating possibilities. Okay, let's look forward a bit more. The dynamic between AI training and inference. This seems like a huge long-term tailwind for ARM.
It really is. It's maybe the biggest underlying shift that plays to their strengths. Right now, a lot of the huge compute build-out, especially in the cloud, is still focused on training these giant AI models. It takes massive power, massive clusters, but over time, the balance is going to flip. The sheer volume of compute needed will shift towards inference actually using those models, running them billions, trillions of times a day for users everywhere.
And inference needs to happen closer to the user, right? Not always back in the cloud.
Exactly. Training can be centralized, but inference needs to be distributed. It needs to run on your phone, in your car, on factory floors and sensors, all these edge devices, and that's where ARM dominates. That battery-powered, power-constrained edge environment is their home turf. They have decades of leadership there, an unmatched install base. So as AI moves to the edge, it moves towards ARM.
So how are they adapting their IP now to handle these more demanding inference tasks at the edge.
We're already seeing it. They talk about strong demand for CPUs and these Lumex CSS components that have features like scalable matrix extensions. That's a technical thing, but basically it's hardware designed specifically to accelerate the kind of math operations that are core to AI models, allowing them to run much faster and more efficiently on low-power devices. They're building the on-ramps for edge AI.
And that bridge between cloud and edge, making
Mhm.
AI run well everywhere, that's also behind their partnership with Meta, right?
That's exactly it. Meta wants their AI models, like Llama, to run efficiently wherever users encounter them, whether it's on a giant server in a Meta data center or on your phone in the Meta app. The partnership is about creating software tools and ensuring the hardware runs efficiently so developers can build AI experiences that scale seamlessly from the cloud right down to an ARM-powered edge device, creating that unified ecosystem.
Okay, so wrapping up the outlook. Given this strong quarter and strategic position, what's the guidance for Q3? What are they expecting?
They sounded pretty confident, citing that strong demand across the board. For Q3, the revenue guidance midpoint is $1.225 billion.
$1.225 billion.
And the growth rate,
That represents about 25% year-on-year growth, still very strong.
and the mix between royalties and licensing.
They expect royalties to be up just over 20% year-on-year, so maintaining that accelerated pace we saw in Q2. Licensing, they guided even stronger, up 25% to 30% year-on-year, continued momentum there.
Okay. What about spending? Is R&D investment still accelerating?
Yeah, Q3 OpEx is guided higher again, around $720 million midpoint.
So they're definitely continuing to invest heavily in R&D. But because the revenue is growing so fast, they still expect strong profitability. Non-GAAP EPS is guided at $0.41 midpoint for Q3.
Got it. And one last check, China, still a significant market. Any specific trends there?
Still very significant, accounted for 22% of their sales in Q2. They said the strength in Q2 was maybe slightly more tilted towards licensing. They signed one of their biggest deals of the quarter there. But royalties are growing strongly in China too. Overall, they described the demand environment there, especially for advanced IP, as looking very robust.
What a fascinating picture. Okay, summing up. For me, the key things jumping out are, one, this record Q2 performance really driven by those high-value royalties from Noverse in the data center and CSS and mobile. It's accelerating. Two, the inescapable conclusion that power efficiency is now the critical battleground for AI compute, and ARM feels very well positioned there. And three, just how effective that CSS strategy seems to be in getting their latest tech deployed much faster, both in phones and potentially in data centers soon.
Yeah, I agree with all that. But if I had to pick one final thought, the thing that underpins all of this, their real long-term advantage, it's the developer ecosystem. They have over 22 million developers writing software for ARM platforms. That's something like 80% of all developers globally. It's immense. And it creates this powerful feedback loop. Every new ARM-based device, whether it's a server or a phone or a car, creates more incentive for developers to build software for it. More software innovation drives more demand for the hardware platform. It's that massive self-reinforcing ecosystem that's incredibly difficult for any competitor, even RISC-V, to replicate at scale. They're not just selling IP, they're enabling an entire global development community. That's the ultimate moat.
The ecosystem is the ultimate competitive advantage. A great point to end on. Thank you so much for tuning in to the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.